Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to focus on the U.S. fiscal position and the latest announcement from the U.S. Department of the Treasury to increase bond purchases, and we'll also have a look at South African inflation. Right, if we have a look at the U.S. fiscal position, there's no immediate sign that U.S. debt to GDP is set to peak anytime soon. At the moment, debt to GDP is running above 100%. And if you look at forecasts, the consensus forecasts, the forecasts from the Congressional Budget Office, they all point to debt to GDP still continuing to rise over the near term. Part of the issue is that the deficit in the US still remains very large as a percentage of GDP. You're looking at estimates of around about 6% or so for the next few years. And it's very difficult for debt to GDP to peak when the deficit each year is of that sort of scale. Now, if we look last week, post the announcement from the US Department of Treasury to buy more bonds, we did see US long bond yields come down, but subsequent to that, they're back in line with where they were pre the announcement. So if the intention was to get yields lower, it didn't work. But what it did do is see a weaker dollar. And this feeds into a broader trend. If you look over the past month, as an example, most of the currencies that we track have strengthened quite materially against the dollar, and that's true over the past year as well. We are in an environment where the dollar is weakening. And it has been our view for some time that the dollar will weaken. We still think the dollar is likely to weaken. If you look at where the dollar is at the moment, by our estimate, it is still strong even after recent weakness. And there'd be some way to go before the dollar would be closer to our estimate of fair value. So in effect, we expect concerns around the fiscal position in the US and a few other issues to lead to some degree of dollar weakness over the coming few years. We've seen some of that. We expect to see more of that. And traditionally, that would imply an outperformance of rest of world equities over US equities as well. As part of this concern around the US fiscal position and the dollar, we have seen a recent sizable ramp in precious metals, looking at gold and platinum in particular. And it's quite interesting. If you look at the broad basket of commodities, we sit in an environment where gold has recently ramped very strongly, platinum has ramped very strongly too, a precious metals trade. Copper has done very well as part of the whole shift, the energy transition shift and increased demand for copper in an environment where supply isn't ramping at all. And then you've got iron ore, which is roughly flat, again, reflecting some concerns that we've expressed around the Chinese economy. And the net result of that is that the broad basket of commodities is doing quite well, but there's a lot of dispersion underneath that, and it does again just feed into this narrative of concerns around the US and the dollar, and we're seeing that expressed in some commodities. And finally, onto SA, we had the SA inflation print come out last week. It did decline from 5% to 4.3%. That was a bit below the consensus forecast of 4.5%, so a bit encouraging. It is important to note, however, that we are due a fuel price increase next month. And if we plug that into our model, along with a few other factors, we see inflation now starting to pick up again, getting to over 5% by November. The SARB didn't hike last time around, but given the trajectory, it's not at all certain that they won't hike at the next meeting. We do expect over the next couple of years that inflation will peak and then head down towards the 3% level. And when it gets to much lower numbers, we expect to see quite sizable cuts from the SARB. But in the interim, we may see a hike before that. And that's where we're going to end it for this week. That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.